Something unusual is happening in the silver market. And if you understand what it means, you'll be better prepared than 99% of investors watching this unfold. The COMEX registered silver vaults are draining at a pace we haven't seen in years. Physical metal is leaving the warehouse system. Inventories that once seemed abundant are tightening rapidly. This isn't about predicting overnight fortunes. This is about understanding a structural shift in a market that most people ignore until it's too late. I'm here to walk you through exactly what's happening, why it matters, and how you can respond with clarity and discipline. Whether you already hold silver or you're considering your first position, this analysis will give you the framework you need. Let's begin by understanding what the COMEX actually is and why these inventory numbers tell us something important about supply, demand, and the future of precious metals. The Chicago Mercantile Exchange, known as COMEX, is the primary marketplace where silver futures contracts are traded in North America. It's where price discovery happens for industrial buyers, investors, and speculators. But COMEX is more than just a trading platform. It's also a physical delivery system backed by a network of approved warehouses. These warehouses hold actual silver bars that can be delivered against futures contracts. The inventory in these warehouses is divided into two categories, eligible and registered. This distinction is critical to understanding what we're seeing today. Eligible silver is metal stored in COMEX warehouses, but not currently available for delivery against futures contracts. It's there, but it's owned by someone who isn't offering it to the market. Registered silver, on the other hand, is metal that's actively available to fulfill delivery obligations. When someone demands physical delivery of a futures contract, it comes from the registered category. Why does this matter? Because registered inventory is the market's buffer. It's the metal that stands between normal market function and potential delivery stress. And right now, that buffer is shrinking. Fast. Over the past 18 months, COMEX registered silver inventories have declined dramatically. We're not talking about minor fluctuations. We're witnessing a systematic drawdown that has accelerated in recent months. At the peak in early 2021, registered silver stood above 150 million ounces. Today, depending on the exact timing you're watching this, that number has fallen well below 50 million ounces. Think about that trajectory. The immediately available supply has contracted by more than 2/3. The metal is being withdrawn and taken into private hands, or moved to eligible status, where it's no longer available for delivery. Some weeks, the registered category loses several million ounces. Other weeks, there's a small replenishment. But the overall trend is unmistakable, down and to the right. This doesn't mean the silver has disappeared from the earth. It means it's no longer participating in the exchange delivery system. Someone owns it and has decided not to make it available to the market. That's a significant behavioral shift. And it's happening while industrial demand for silver remains robust, and investment demand shows signs of renewed interest. Let's talk about what's driving this drawdown. There are several forces at work, and they're converging in ways that create pressure on physical supply. First, there's the structural supply-demand imbalance. Silver mining supply has been relatively flat for years. Major new discoveries are rare, existing mines are aging, and silver is often a byproduct of other mining operations, which means dedicated silver supply doesn't respond quickly to price signals. On the demand side, industrial applications continue to grow. Solar panels require significant amounts of silver. Electronics, medical devices, water purification, and emerging technologies all consume physical metal that doesn't return to the market. Then there's investment demand. After years of relative quiet, we're seeing renewed interest in precious metals as inflation concerns persist and confidence in fiat currency systems wavers. But here's what makes the COMEX situation particularly interesting. Delivery behavior has changed. In the past, most futures contracts were settled in cash. Traders would close positions before expiration, avoiding the complexity of physical delivery. That pattern is shifting. More contracts are going to delivery. More market participants are standing for physical metal rather than rolling contracts forward or settling in cash. Why? Because sophisticated players understand that paper claims and physical possession are not the same thing. In an environment where trust in financial institutions is uncertain and currency debasement is ongoing, physical assets gain appeal. When more people want delivery and less metal is registered for delivery, you get exactly what we're seeing: inventory drawdown. This isn't the first time we've seen stress in precious metals delivery systems. History offers us valuable context. In the 1970s, silver experienced a dramatic surge as inflation ravaged purchasing power and investors fled to hard assets. The Hunt brothers famously attempted to corner the market, and while their specific strategy ended in failure, the underlying supply dynamics were real. In 2011, silver spiked above $48 per ounce during a period of monetary expansion following the financial crisis. Physical premiums soared. Delivery delays became common. The gap between paper price and physical availability widened. More recently, in early 2021, we saw a brief squeeze attempt driven by retail investors coordinating online. While the price impact was temporary, it revealed something important. The physical market is smaller and less liquid than many people assume. Each of these episodes shared common features: monetary uncertainty, inflation concerns, growing recognition that paper claims may not translate to physical metal when demand surges. The current situation differs in one key respect. It's developing more gradually. This isn't a parabolic spike driven by speculative mania. It's a steady, persistent drawdown occurring, while price remains relatively subdued. That pattern suggests something structural rather than speculative. It suggests informed accumulation rather than panic buying. And historically, the structural moves are the ones that precede the most significant price adjustments. To understand why this matters now, we need to zoom out and look at the larger economic environment we're operating in. Central banks worldwide have expanded their balance sheets to unprecedented levels over the past 15 years. Money supply growth has outpaced economic growth by substantial margins. The currency supply has been inflated, while the supply of real goods and hard assets has not kept pace. This creates an inherent tension: more monetary units chasing a relatively fixed supply of tangible assets. It's the most basic economic principle. When supply is constrained and demand increases, prices adjust. We're also seeing a shift in how nations and institutions think about monetary reserves. Central banks have been net buyers of gold for over a decade. De-dollarization is no longer a fringe theory. It's an observable trend in international trade settlements. Silver sits in an interesting position within this shift. It's monetary in history and perception, yet it's also industrial in current primary use. That dual nature gives it characteristics of both a monetary hedge and a strategic commodity. Energy transition policies, regardless of your view on their merits, require massive amounts of silver. Solar panel manufacturing alone consumes a significant and growing portion of annual silver production. At the same time, financial repression continues. Real interest rates, adjusted for actual inflation, remain negative in most developed economies. That environment punishes savers and rewards those who hold real assets. These are not short-term phenomena. These are decade-long structural trends that create a backdrop where hard assets become increasingly relevant to portfolio construction. Data is only valuable if we interpret it correctly. So what exactly does the COMEX registered inventory decline signal? It tells us that the marginal ounce of silver is becoming more valuable to its owner than the price currently reflected in futures markets. Someone is willing to withdraw metal and forgo the convenience of exchange trading because they believe holding physical is more advantageous. It tells us that confidence in the paper derivatives market may be eroding among sophisticated participants. When registered inventory drops, it means fewer people are willing to let their metal serve as delivery stock. It suggests that the people closest to the market, those with the most information, are behaving in ways that indicate supply concern. Inventory drawdowns don't happen in vacuums. They happen when informed participants see value in securing physical possession. This doesn't guarantee an imminent price explosion. Markets can remain disconnected from fundamentals longer than seems rational. Price discovery in heavily traded futures. Markets can be influenced by factors beyond simple supply and demand. But it does tell us something about underlying physical availability. And in commodity markets, physical availability eventually matters more than paper trading volume. Think of registered inventory as the shock absorber for the delivery system. When it's ample, the system handles delivery requests smoothly. When it thins, the system becomes vulnerable to stress. We're watching that shock absorber compress in real time. Understanding market psychology helps us anticipate how situations like this tend to unfold. Right now, silver remains relatively unloved compared to other assets. It hasn't captured mainstream attention the way technology stocks or cryptocurrencies have. Most investors don't think about it at all. That's actually significant. Markets make their most important moves when positioning is one-sided and attention is elsewhere. When everyone is watching, opportunities are usually limited. When few are paying attention, that's often when structural shifts begin. The professionals who track COMEX inventories know what's happening. But the broader investing public remains largely unaware. This creates an information asymmetry that tends to favor those who do their homework. We also need to consider the emotional cycle that characterizes precious metals investing. Long periods of quiet accumulation followed by short, intense periods of recognition and price adjustment. During the quiet phases, patient accumulation is possible at reasonable prices. During the recognition phases, availability tightens and premiums expand rapidly. The key is understanding which phase you're in. The inventory data suggests we're still in an accumulation phase, but one that's maturing. The drawdown is consistent, but hasn't yet triggered the kind of attention that creates self-reinforcing momentum. That could change, and when it does, the shift tends to happen faster than most people expect. If you already hold physical silver, your strategic position is straightforward but requires discipline. First, recognize what you own. You hold a tangible asset with no counterparty risk. It doesn't depend on anyone else's promise or obligation. In an era of complex financial instruments and interconnected systemic risks, that simplicity has value. The current inventory situation validates your thesis. You made an allocation decision based on supply-demand fundamentals, monetary uncertainty, or portfolio diversification. The data we're seeing supports that decision. But validation doesn't mean complacency. You need to be clear about your objectives. Are you holding silver as portfolio insurance? As a long-term store of value? As a speculation on price appreciation? Your holding period and exit strategy should match your original rationale. If you bought for monetary insurance, then current price fluctuations are largely irrelevant. If you bought as a trade, you need defined profit targets and risk parameters. One critical discipline: resist the urge to overtrade your position. Every time you sell and buy back, you incur transaction costs and premiums. In physical markets, round-trip costs are substantial. That friction works against you. If the situation develops as the inventory data suggests it might, there will be moments of volatility. Sharp moves up, followed by corrections. Media attention followed by quiet periods. This is normal in commodity markets. Your advantage as a physical holder is that you're not forced to react to short-term price action. You're not facing margin calls. You're not getting stopped out of positions. You can wait for developments to unfold. Maintain perspective on position sizing. Physical precious metals should be part of a diversified strategy, not your entire net worth. If you're properly positioned, you can hold through volatility without emotional distress. And consider this. If the registered inventory continues to drain and physical tightness increases, you may find that selling becomes less attractive than you anticipated. The optionality of holding a scarce asset in a tightening market has value in itself. If you don't currently hold silver but are considering a position, you're evaluating this opportunity at an interesting moment. The inventory data suggests underlying tightness, but price hasn't yet fully reflected that dynamic. This gap between physical fundamentals and paper price often represents opportunity, but it requires patience. Let's be clear about what you're getting into. Physical silver is not a momentum trade. It's not going to move like a technology stock. It's a strategic allocation that makes sense as part of a broader portfolio approach. Your first decision is physical versus paper exposure. You can buy actual coins and bars, or you can buy shares in silver ETFs or mining stocks. Each has different risk and reward characteristics. Physical ownership gives you direct exposure with no counterparty risk. You hold the actual metal. But it requires secure storage, has higher transaction costs, and is less liquid than financial instruments. ETFs offer convenience and liquidity, but introduce counterparty risk and management fees. You're trusting that the fund actually holds the metal it claims and will honor redemptions under all circumstances. Mining stocks offer leverage to silver prices, but come with company-specific risks, operational challenges, and management quality variables. They're equity investments with commodity exposure, not pure commodity plays. If you're building a position, consider averaging in over time rather than committing everything at once. This reduces timing risk and allows you to accumulate through price fluctuations. Understand the premium structure. Physical silver typically trades above spot price. The premium covers minting costs, distribution, and dealer margins. These premiums vary with demand and can spike during periods of high interest. Right now, premiums are elevated compared to historical averages, but not extreme compared to periods of real shortage. That's worth noting. Set realistic expectations. Silver can be volatile. It can consolidate for months or years before making significant moves. If you need short-term liquidity or can't tolerate price fluctuations, this may not be the right allocation for you. But if you understand the long-term case, believe in the fundamental supply-demand dynamics, and can hold through volatility, the current setup offers a reasonable entry point with the inventory data providing fundamental support. Let's talk about the practical discipline of position sizing, because this is where most investors make critical errors. Position sizing should be determined by your overall financial situation, risk tolerance, and investment objectives, not by your enthusiasm for the asset or your conviction in the thesis. A common framework suggests that precious metals should represent somewhere between 5 and 15% of an investment portfolio. Within that allocation, silver might represent a portion, with the remainder in gold and possibly platinum or palladium. These aren't rigid rules. They're starting points for thinking about appropriate exposure. A younger investor with decades until retirement might size differently than someone approaching retirement. Someone with stable employment and emergency reserves might allocate differently than someone with variable income. The key principle is that your silver position should be sized such that you can hold it through substantial price volatility without being forced to sell at an inopportune time. If a 50% drawdown in your silver position would create financial stress or force you to liquidate other assets, you're oversized. If you wouldn't notice or care about that decline, you're properly sized or possibly undersized given your apparent risk tolerance. This matters because silver can be volatile. We've seen 40% corrections during longer-term bull markets. We've seen multi-year consolidations that test the patience of even committed holders. Your position size should assume you'll experience volatility, not hope you'll avoid it. Build your allocation with the assumption that you'll see your position underwater at some point, potentially for extended periods. This approach does two things. It prevents emotional decision-making during drawdowns, and it allows you to potentially add to positions when others are capitulating. Risk management also means maintaining balance across asset classes. Don't abandon diversification because one thesis seems compelling. Don't liquidate productive assets to over-concentrate in precious metals. The goal is resilience across different economic scenarios, not maximum exposure to a single outcome. This is important enough to warrant its own section. Leverage and precious metals are a dangerous combination for most investors. The allure is obvious. If you believe silver is going higher and inventories suggest supply tightness, why not amplify your exposure through leverage? Why not use margin, options, or leveraged ETFs to increase potential returns? Here's why. Because precious metals are volatile, and volatility destroys leverage positions through mechanisms most people don't fully appreciate. Futures contracts require margin. When prices move against you, you face margin calls that can force liquidation at exactly the wrong time. Even if your long-term thesis is correct, short-term volatility can eliminate your position. Options decay over time. Even if the price eventually moves in your favor, if it doesn't do so within your options time frame, you lose your entire investment. Timing becomes everything, and timing commodity markets consistently is nearly impossible. Leveraged ETFs use derivatives and daily rebalancing that creates tracking error and decay over time. They're designed for short-term trading, not long-term holding. Over extended periods, they will underperform the underlying asset even if direction is correct. I've seen investors with correct fundamental theses lose everything because they couldn't withstand the volatility their leverage created. They were right about the destination, but couldn't survive the journey. If the COMEX inventory situation develops into actual supply stress and price appreciation, unleveraged physical holders will capture that move. Leveraged traders may get stopped out during routine volatility and miss the eventual move they were trying to amplify. Leverage transforms investing into trading. It shifts your edge from patience and fundamental analysis to timing and technical execution. Unless you're a professional trader with risk systems and emotional discipline, that's a losing trade. Hold physical, size it appropriately, be patient. That's a winning formula. Adding leverage to that formula usually just introduces new ways to lose. Let me be direct about the behavioral errors that destroy wealth in situations like this. Mistake 1. Chasing price momentum. If silver begins to move higher rapidly and capture attention, your worst instinct will be to buy more at elevated prices because you fear missing out. This is exactly backward. You should be buying during quiet periods when no one cares, not during excited periods when everyone's watching. Mistake 2. Selling on temporary weakness. Markets test your conviction. They always do. If you've done your analysis and sized your position properly, temporary price declines are not reasons to abandon your thesis. They're often opportunities to add. Selling during fear is how wealth transfers from weak hands to strong hands. Mistake 3. Over-concentrating into a single asset class. Yes, the silver inventory data is compelling. No, that doesn't mean your entire portfolio should be precious metals. Maintain diversification, maintain balance. Don't let conviction in one thesis override basic portfolio discipline. Mistake 4. Trading on rumors and social media narratives. The internet amplifies noise. You'll see countless predictions, theories, and supposed insider information. Most of it is worthless. Base your decisions on verifiable data and sound analysis, not on what someone claims in a forum or chat room. Mistake 5. Ignoring liquidity needs. Don't invest money you might need in the next year or two. Physical precious metals are not cash. They take time to sell, they have transaction costs, and during market stress, bid-ask spreads can widen significantly. Maintain appropriate cash reserves for life's uncertainties. Mistake 6. Comparing yourself to others. You'll see people who bought earlier, who hold more, or who seem to be profiting while you're not. This is poison. Your financial situation is unique. Your timeline is unique. Comparison only leads to emotional decision-making. Mistake 7. Assuming paper price reflects physical availability. The COMEX price is determined by futures trading, which is substantially larger than physical trading volume. During periods of physical tightness, the paper price can disconnect from physical reality. Don't assume that because the price isn't moving, the fundamentals aren't developing. Mistake 8. Neglecting security and storage. If you hold physical metal, you need proper storage. You need security measures. You need to think about estate planning and ensuring your heirs can access what you've accumulated. These aren't exciting topics, but they're essential. Mistake 9. Trusting predictions about timing. No one knows when a supply squeeze translates into price movement. No one knows when inventory drawdowns trigger delivery stress. Beware anyone claiming certainty about timing. The best investors focus on probabilities and position accordingly, not certainties and timing precision. Mistake 10, letting precious metals investing become your identity. This is an investment thesis, not a religion. It's part of your financial strategy, not your personality. Maintain perspective. Maintain balance in your life and your thinking. Understanding how the COMEX delivery system works helps you appreciate what's at stake as inventories decline. When someone holds a silver futures contract into expiration and stands for delivery, the exchange must allocate them a warrant representing physical metal in an approved warehouse. That metal comes from the registered category. The contract size is 5,000 ounces. That's a significant amount of silver, roughly 140 kilograms. It's not a casual transaction. Historically, only a small percentage of contracts went to delivery. The vast majority were settled in cash or rolled forward to future delivery months. The system was designed around this assumption. But behavior changes. When market participants lose confidence in cash settlement, when they want physical possession rather than price exposure, delivery percentages increase. The system can handle elevated delivery rates if registered inventory is ample. But when registered inventory is thin, there's less buffer. Each delivery request represents a larger percentage of available stock. At some point, if the trend continues, you reach a threshold where delivery requests could exceed registered inventory. That's when market structure becomes stressed. We're not there yet, but the trajectory suggests we're moving in that direction. What happens at that threshold? Historically, several things can occur. Price premiums for physical metal can spike, delivery delays can develop, the exchange can modify rules around delivery, additional metal can be moved from eligible to registered status. The market finds equilibrium, but often at price levels significantly different from where stress began. This is why the inventory data matters. It's an early warning signal that market structure is changing, and market structure changes often precede price regime changes. We need to address the industrial side of the silver equation because it's fundamentally different from gold's monetary focus. Roughly half of annual silver demand comes from industrial applications. This creates both opportunity and complexity. Industrial demand is relatively price inelastic in the short term. If you're manufacturing solar panels or electronics, you need silver to complete your product. You can't easily substitute other materials without redesigning your manufacturing process. This means industrial users will continue purchasing even as prices rise, up to a point. Their demand doesn't simply evaporate because silver becomes more expensive. Solar energy expansion alone is projected to require hundreds of millions of ounces of silver over the coming decade. Whether that projection proves accurate depends on energy policy, technological development, and economic conditions. But the trajectory is clearly toward increased industrial consumption. Medical applications, water purification, electronics, and emerging technologies all add to this structural demand. Some of this demand is growing, very little is declining. On the supply side, silver mining is constrained. Most silver comes as a byproduct of other mining operations, primarily copper, lead, and zinc. This means silver supply doesn't respond quickly to silver prices. If copper demand is weak, copper mines reduce production and silver supply contracts regardless of silver prices. The supply curve is partially determined by other commodity markets. Primary silver mining exists but represents a minority of supply. These operations are sensitive to silver prices, but they can't rapidly expand production. Mine development takes years and requires substantial capital investment. Recycling provides some supply, but is limited by the distributed nature of silver use. Unlike gold, which is concentrated in jewelry and bullion, silver is dispersed across thousands of industrial applications in small quantities per unit. The industrial demand profile creates a floor under silver prices and a ceiling on supply responsiveness. This is part of what makes supply dynamics interesting when investment demand increases alongside persistent industrial demand. Let's address the elephant in the room, the monetary environment that makes hard assets increasingly relevant. We're living through the largest monetary experiment in human history. Central banks have expanded money supply at rates that would have seemed impossible 2 decades ago. This isn't a political statement, it's observable fact. When money supply grows faster than the economy's capacity to produce goods and services, you get inflation. Not the temporary kind that corrects quickly, the structural kind that erodes purchasing power persistently. Official inflation metrics often understate the real erosion of currency purchasing power. The methodology for calculating inflation has changed over time, generally in ways that reduce reported numbers. But you don't need statistics to understand this. You see it in the prices you pay for housing, healthcare, education, food, and energy. The currency buys less each year. This creates a simple problem for savers. How do you preserve purchasing power when the currency is being systematically devalued? Traditional solutions, like bonds, offer yields that are negative in real terms. Stocks offer growth potential but come with substantial volatility and valuation risk, particularly when trading at elevated multiples. Hard assets offer an alternative. They can't be printed. They can't be inflated away. Their supply is constrained by physical reality, not policy decisions. Silver sits within this framework as an accessible hard asset with both monetary history and industrial utility. It's more affordable than gold for smaller investors, but offers similar monetary hedge characteristics. The COMEX inventory drawdown is occurring within this broader monetary context. It's not happening in isolation. It's happening as sophisticated investors increasingly question the long-term stability of fiat currency systems. This doesn't mean imminent collapse. It means gradual reallocation toward assets that hold value independent of government policy and central bank decisions. Context matters. Let's briefly consider silver relative to other investment options. Compared to gold, silver is more volatile, more industrial, and historically more affordable for smaller investors. The gold-silver ratio, which measures how many ounces of silver equal 1 ounce of gold, has varied widely over history. Currently, that ratio sits well above its long-term average, suggesting silver is relatively cheap compared to gold. Whether it reverts to historical means depends on many factors, but the divergence is notable. Compared to stocks, silver offers no cash flow, no earnings growth, no dividends. Its value derives entirely from scarcity, utility, and monetary perception. This makes it fundamentally different from productive assets. But that difference is also its strength. Silver doesn't depend on corporate management, economic growth, or market sentiment about growth assets. It's a pure store of value play. Compared to real estate, silver is liquid, portable, divisible, and requires no maintenance. Real estate offers utility and potential income, but comes with substantial transaction costs, ongoing expenses, and concentration risk. Compared to cryptocurrencies, silver has thousands of years of monetary history, physical existence, industrial utility, and no dependence on technology infrastructure or regulatory acceptance. Each asset class serves different purposes. The question isn't which is best in absolute terms. The question is which combination provides resilience across different economic scenarios. Silver's role is typically as a portfolio hedge and store of value component. It's not meant to be your primary wealth-building vehicle. It's meant to preserve purchasing power and provide optionality during monetary uncertainty. We should acknowledge the geopolitical dimensions because they're increasingly relevant to commodity markets. Global silver mining production is concentrated in a handful of countries. Mexico, Peru, China, Russia, and Poland are among the largest producers. Any disruption to production in these regions affects global supply. Trade relationships are becoming more complex. The era of seamless globalization is evolving towards something more fragmented. Supply chains that seemed reliable now face political risk. Energy security concerns affect mining operations. Silver extraction requires significant energy input. Rising energy costs or energy availability constraints impact production economics. Currency dynamics matter too. Most international commodity trading occurs in US dollars. As de-dollarization trends develop, even gradually, the framework for pricing and trading commodities may shift. Strategic resource considerations are emerging. As nations focus on energy transition and technological competition, access to critical materials becomes a matter of national interest. Silver sits at the intersection of these concerns. It's both a monetary metal and an industrial input for strategic technologies. That dual nature gives it relevance beyond simple investment considerations. I'm not suggesting imminent geopolitical crisis. I'm noting that the global framework around commodity production and trade is less stable than it was a decade ago. That instability adds a layer of supply uncertainty to markets like silver. And uncertainty around future supply makes current physical holdings more valuable. If you're tracking this situation, here are the key indicators to monitor. First, and most obviously, continue watching COMEX registered inventory levels. The trend matters more than week-to-week fluctuations. Is the drawdown continuing, accelerating, stabilizing, reversing? Second, watch physical premiums. The spread between paper spot price and actual purchase prices for coins and bars tells you about real-world supply and demand. Expanding premiums indicate physical tightness, even if futures prices aren't reflecting it. Third, monitor delivery rates on futures contracts. What percentage of contracts are going to delivery versus being rolled or cash settled? Increasing delivery percentages suggest behavioral shifts toward physical possession. Fourth, track industrial demand data, particularly from solar panel manufacturing and electronics production. These sectors provide steady baseline demand that supports price floors. Fifth, observe mining supply data. Are production levels increasing, stable, or declining? Are major miners bringing new supply online or facing operational challenges? Sixth, watch central bank policy and real interest rates. Negative real rates make non-yielding assets like silver more competitive. Policy shifts toward higher real rates would change the calculus. Seventh, pay attention to currency volatility and confidence indicators. Silver often responds to currency crisis fears and inflation concerns. Eighth, notice what other smart investors are doing. Are institutions increasing precious metals allocations? Are central banks buying? Are sovereign wealth funds adjusting positions? None of these indicators alone tells the complete story, but together they form a mosaic that helps you understand whether the fundamental thesis is developing or deteriorating. The inventory data is your primary signal. The other factors provide context and confirmation. This may be the most important section for your long-term success. Commodity markets move in cycles that are often longer than investors anticipate. Silver can consolidate for years before making significant moves. During those consolidation periods, maintaining conviction is difficult. You'll face doubt. You'll wonder if your analysis was wrong. You'll see other investments performing better. You'll feel the psychological weight of opportunity cost. This is where most people fail, not because their fundamental analysis was wrong, but because they couldn't maintain discipline through the quiet periods. The inventory drawdown we're discussing is a slow-motion development. It's not a crisis unfolding over days or weeks. It's a structural shift occurring over quarters and potentially years. Your ability to benefit from this shift depends almost entirely on your patience. Consider what patience really means in this context. It means continuing to hold when holding seems pointless. It means not abandoning your position because something else looks more exciting. It means trusting your process and your research even when outcomes aren't immediately visible. Patience doesn't mean passivity. You should continue monitoring the situation. You should adjust if fundamental conditions change, but you shouldn't confuse normal market volatility with fundamental deterioration. The greatest wealth transfers in commodity markets happen when patient, informed holders are proven right and impatient traders have already exited. If your thesis is correct, if supply tightness eventually manifests in price, those who maintained positions through the quiet period will benefit. Those who traded in and out will have given up most of their advantage to transaction costs and poor timing. Patience is your competitive advantage as an individual investor. You don't have quarterly performance pressure. You don't have clients questioning your positions. You can wait. Use that advantage. Let me bring this together with some final thoughts. The COMEX registered silver inventory drawdown is a real, observable phenomenon. It tells us something meaningful about supply dynamics and market participant behavior. Does it guarantee price appreciation? No, markets never provide guarantees. Does it suggest that physical silver availability is tightening while demand remains robust? Yes. Does it create a risk-reward setup that favors patient, disciplined accumulation? I believe it does. But your success with this opportunity, if you choose to engage with it, depends far more on your discipline than on the fundamentals. You need clarity about your objectives. You need appropriate position sizing. You need emotional resilience to hold through volatility. You need patience to let developments unfold at their own pace. You need to avoid the behavioral traps that destroy wealth: over-leveraging, over-trading, over-concentrating, panic selling, euphoric buying. If you can maintain discipline, if you can think in years rather than weeks, if you can base decisions on data rather than emotion, you put yourself in a position to benefit from structural market developments. The inventory data doesn't predict the future. It illuminates the present. What you do with that information is entirely up to you. My role here has been to provide you with context, analysis, and perspective, to help you think clearly about what's happening and what it might mean. Your role is to make informed decisions appropriate to your unique situation and to execute those decisions with discipline and patience. The COMEX vaults are telling us a story. Physical metal is leaving the delivery system. Registered inventory is declining steadily. Market structure is tightening. How that story unfolds depends on countless variables we cannot control or predict with certainty. But we can control our response. We can prepare appropriately. We can position ourselves to benefit if the fundamentals we're observing translate into the price adjustments that often follow supply tightness. We can do so without hype, without guarantees, without unrealistic expectations. That's the path of the disciplined investor. That's the approach that builds wealth over time. The COMEX inventory data has given us information. What we do with that information, how we respond to it, and whether we maintain our discipline through what comes next will determine our ultimate outcomes. Stay informed, stay disciplined, stay patient. The market will do what it does. Make sure you're positioned to benefit when it does. Thank you for your time and attention. I hope this analysis helps you navigate these complex markets with greater clarity and confidence.